I've been trading 20 years, which kind of puts me at 18, as I'm only 38 now. I probably look about 108, especially with the move in the last 4 months. And we've got some guys in Chicago, a couple of guys in the pit in New York, and some guys in London as well. Our quants and our programmers are based in London. Myself, I'm not sure if Ryan's already told you or not, but I live in the middle of nowhere, which is just how I like it. So I'm kind of open to all your questions, and we'll see where it goes.
Okay, brilliant. So what I'm going to do is you've got 10 pre-prepared questions that I'm going to run through, and then I've got about 20 questions off of the forum guys, and then I've got a couple of questions of myself. And once we've run through all them, if there's any more questions that anyone has, they can type them in the box, and we can just answer them live and then finish up. So, yeah. Okay, so the first question was how long have you been in the markets for? You've already sort of answered that. The second one was where are you based? You've also already answered that. Third one is how have you structured how are you structured as a company?
Okay, so we don't take any client funds, so the company is my funds. All the guys that work for the company, effectively, they're paid by me. So the cash that we put up is just very, very similar. As much as you guys are retail traders or commercial traders, you're placing your own capital with the exchanges. We do exactly the same thing. So we don't handle any customer money. We've got a couple of funds that what's known as they shadow trade what we do, or suspense trade, as the official term is known. But they're quite small. They pay a decent fee to us to do that, but all of the business is our flow, self-generated. We're a UK-based entity, whilst we have obviously presence in Chicago. All of the equipment, servers, is in Chicago. Human beings in New York, and human beings in and around London.
Okay, brilliant. So how many people do you have on your team then at a minute?
So there's 2 algo programmers, 1 quant, a couple of juniors. We've got 1 guy, well, a team of 2. I only can obviously speak to 1 guy in the pit in the NYMEX, and we've got an IT guy in Chicago, and also another guy that we talk to not as much because we do a little bit of Eurodollar stirs in Chicago as well. So that's the whole team.
Awesome. So do you consider yourself as a speculator, as a retail trader would then?
Everyone's a speculator. I think there's lots of confusion around the marketplace, and unless you're kind of pulling crude out of the ground or cracking it for gasoline, you're speculating. So if you look at how the CME classifies its entities, you need to be the things I just said, or you're classified as a hedge fund or a retail guy. There isn't anything in between.
Yeah, that's correct. Okay, I'll move on to the next question. So can you give us some background to the energy space and how the macro levels are constructed?
Okay, so I think one of the reasons that, I'm on Twitter and I follow a lot of people. We actually wrote some programs that look at what people are saying and thinking, and I wanted to just clarify just how broad the energy space is, rather than a lot of people just think that the CME's WTI contract is everything. In reality, it's actually quite a small percentage. You've got the large brokers of the physicals, such as Vitol and Glencore, as an example. They're trading with the main producers and the exploratory divisions of the likes of BP, Shell, Exxon, and they're then obviously looking to sell that on to the usual importers. Now, classic importer is Japan. I think they're 100% crude import. The Chinese, they're brokering those deals, and to hedge those what were traditional kind of storage and ship deals, they'll use the futures market. They'll also use the OTC market, so that means the over-the-counter market, so 2 parties agree themselves. And some of it flows into the futures market. The futures market is much better for understanding the curve rather than the moment, and I'll explain that a little bit later. And then you've obviously got the WTI contracts within that, that's out of Cushing, Oklahoma. So you've only really, WTI is just a representation of one type of crude that's 7 or 8 actively pulled out of the ground in the United States. It's one type of crude oil delivered to one point. It's just got a lot of volume, and obviously Brent is an amalgamation of, I think, the old Brent oil fields that BP back in the day used to call all of their oil finds after names of birds, and that's why it's called Brent. It's also an amalgamation of some Norwegian crude and some Dutch crude as well, and that's what Brent is. But they're the kind of core blends. You now got the other bigger products like the Oman Lights, the Oman Heavies coming out of Dubai, like Louisiana, obviously we know that's from, and then you've got all the Bakken coming out of Canada. All of these kind of get blended by the bigger guns like 𝗕𝗺𝗄 and Glencore of the world. They will blend that overall basket price and look at where they can hedge that, and the ultimate hedging tool is clearly the futures contracts. No one puts crude in their car, and you don't oil your door with crude oil if it's a squeaky door. It needs to be cracked, and it's the products that drive our market, and that's the really key thing to understand. No one buys crude oil to put a barrel of it in the car. I think everyone remembers that. It's a good thing.
Yeah, I think a lot of people get confused about that. A lot of people that sort of ask me questions about what I do in the markets, when I say I trade oil, they think when oil prices go up or down, they don't understand how it affects the petrol pump price. Obviously, that's the thing.
Yeah, and it always amazes me as well. I mean, my dad always says to me, "Why hasn't the price of petrol gone down if crude oil's gone down?" And I try to explain to him that 60% of it's taxed in the UK, and the US is a lot more immediately receptive to changes there because it's not so heavily taxed. But yeah, I think to be a good energy trader, that you need to be more aware of the cracks and the product. That people trade product. The outcome is the product. The input is the crude.
Okay, awesome. We'll go into a little bit of the cracking side in a bit. Okay, should we move on to the next question?
Yeah, sure.
I think you got it in the next question. So, do you watch the forward curve in the energy and the spreads?
Yes, absolutely. It's everything. The front month might be the most fun and the most volume, but you'll never get rich trading the front. The intelligence is in the curve, and you tend to find that we're in contango at the moment. We were steeply in backwardation, but if you wanted to see where crude was going, if you were looking at the December contract in June, it kind of told everybody. They were pushing hard that December contract way before pushing anything else, because they can get cheap liquidity, and when storage builds up, that crude's kind of got a longer time frame. They don't just turn the tap on at Cushing and it arrives in your back garden. There's a long period of time. So that forward curve is critical to assess and understand how that impacts trade.
And you think that's more of a macro perspective, more than a sort of day time frame thing to look at?
Yeah, I mean, you can see, we trade a lot of options, and I can see them hitting a June, for example, and I'll see the spread bend. The June deck will bend, and then the February June will bend the other way, because they're smashing an option into June. Which will affect all the spread traders, because there's a lot of guys out there making condors and flies out of futures, not options, futures, and they live off that. So they're living off that liquidity or lack of liquidity. Sometimes you've got to hit the front and then leg out into the month you want to be in, because all the juice is in the front.
Okay.
to answer your question,
Yeah, go on.
I watch it daily, minute by minute. For an options trader, it's called beta spanning. We want to understand what percentage move the curve will do for a 1% move in the front. So if the front jumps up 1%, does December jump up 1%, or is it 0.6%? And if that moves from 0.6% to 0.8% across that bend, it's an incredibly telling scenario.
Interesting. I've never really sort of got into the option side of this business, so that's something I've sort of looked to work with moving forward. So that's interesting.
Yeah, it tends to be on the option side is where the size is done. So what I mean by that is, if you want to sell 50,000 contracts over a course of 3 days, you'll impact the market. Even a bid market, you will impact. But if you structure a strategy in the options, you can get that done in 3 or 4 tickets in an afternoon.
So do you think there's more volume that goes through options than futures then?
There's not necessarily more volume. The front is obviously the number one for volume. Tends to be the front two in the Brent contract has a better curve. But it's more, you get more bang for your buck, because if you're putting something on that's only a 6 or 7 delta strategy and you want to do 100,000 lots, you only need to sell 6,000 lots in the front to cover it. So you can get more power if you're on the commercial side.
Okay. Should we move on to the next question then?
Yeah, sure.
Okay, so what products do you market make then?
We market make Brent and WTI. So the WTI on the CME, so actively the front month or the front 6, and the options, the American options, both blocks, 𝗕𝗺𝗺 and 𝗕𝗺𝗺, and on the Brent tends to be obviously on the futures side. On the options side, the futures obviously all electronic. The options is much more OTC cleared in the Brent space through brokers, and then obviously the products as well, and some of the spreads. So we'll quote heating oil, we'll quote gasoline, we'll quote a little bit of natural gas, not much, but we a lot of the spreads, usually kind of a two-way price, anything up to 23 hours of the day. The majority of them, crude more kind of 20 hours plus a day, but the others tend to be, it varies. There's not really a gasoline market, an RBOB market, heating oil market outside of the pit hours.
Yeah. So is there a reason why you decided to specialise in energies other than sort of, obviously there's a huge amount of products out there to market make or trade? So.
Why do we specialise in energy? It's a very good question. I think it's one of those things that I spent my time at Goldman's actually in a different product set. I was in currencies, and we did a little bit of commodities, and I guess I was just long-term bored of 10% vol, and with crude anywhere between 40 and 60% volatility, it makes for a much more exciting market.
Yeah, it's a very volatile market, crude.
Yeah.
Natural gas is just, I don't know, it's pretty crazy too. So.
Yeah, it's harder to get a size on there. It's kind of a couple of hundred contracts, and you can move gas, and you can get a size on in crude.
Obviously, gold is another wacky market as well with regards to volatility. Have you ever sort of?
No, we obviously the crude oil options pit is next door to the gold pit on the NYMEX. And no, believe it or not, my boys stand right in between the gold pit and the crude pit, and they've never done a gold trade because we just haven't traded it.
Okay. Okay, we'll move on to the next question. So I think you've already sort of explained this, but not half this question. But who are your customers and who are your competitors?
Everyone's a customer and everyone's a competitor. That's the easiest way of answering that question. If you trade crude, I mean, if you're looking at it now, it's 59.61. We'll be, 10 of those on the bid and 15 of those on the offer. So if you hit us and you're right, then well done. If you give us and goes up, then we beat you. So we're pretty much every single price. You can't, for the volume that we're doing, you'll always be trading with us. And to answer the question of who are the competitors and who are the customers, we'll always quote brokers because we want that commercial paper, but the customer lies with them. The last people I want to be trading with all day long is other market makers. Although that said, we can, there's a lot of hype in the market about algos hunting impacts. It's largely untrue, but there are times, especially outside of core market hours, where you can get other volume and time sliced order traders to cut the play with you, and you can start to kind of understand what it is that they're, how can I explain? So if you know one's selling and there's stops below, you can use his order and keep hitting in front of him to make him chase the order down. So whilst they're always competitors, if they're fighting on your side, that they become allies rather than customers.
So your main competitor obviously is other market makers that are like you then, in that sense?
No, I mean we don't really have any competitors per se. You guys are our competitors. Hold on a second, turning down. If you trade and if you buy a 20 lot from us at 56 and it goes 65 bid, then well done. You were competitive against us. I think the key thing to understand is we see all these things as a kind of cost per lot and a profit per lot. So, if you're doing 40,000 lots a day, we aim to make about $2 a lot, which is obviously less than the value of a tick, but that's how we operate after costs. I think some of the most aggressive E-mini guys out there, doing a couple of 100,000 E-minis a day, he's looking anywhere between $1.80 and $1.85 a lot on his 200,000, which is still, nearly $0.4 of a million a day.
It's a huge amount. So at the minute, I think you said you're averaging about 40,000 contracts a day on cruise. That's roughly about 10% of the market volume. That's correct.
Yeah. Sometimes higher. I mean, we tend to be a lot higher earlier in the day. So if you trade before the pit opens, kind of 9 o'clock London time through till 1 o'clock London time, we're pretty much 40%. And that goes a lot lower when everyone else joins in the pit session. And obviously volume goes up. Our percentage, the number of trades we do doesn't decrease, it actually increases, but there's other guys in there. So if crude opens the day, at 60,000 or something, then we'll pretty much be 25, 23,000 of those already.
That's cool. So on the market open, on the pit session and the close, do you tend to do, obviously there's a lot of volume that comes in on the open orders and on the close orders. Do you tend to quote more in them time periods through that phase?
No, it doesn't make any difference to us. I mean, it's just, we look at, this. It depends which way we're positioned. It depends. Sometimes you'll see a lot of volume come in on the pit open. Sometimes you'll see a lot of volume get sucked out on the pit. It's hard to kind of gear. There's a lot of systems. I despise the word systems, but okay, there's a lot of systems that get turned on at those times, which generates order flow. And if those systems are, 10 people with accounts trading 10 lots, there's 100 lots order straight away, and they're just kind of buy on open because the previous day was a high bar. Those kind of things exist, and they don't really care what the price is, so they actually kind of can generate quite a bit of cash because they'll just pay an offer at 50 and the next price is 45 offered because someone else wants to dump it, and we just sit in between.
Yeah, it's a lot of random order flow on the open sometimes. So,
yeah, and on the close. The close is a bit nice. The close tightens up a little bit, so you tend to find on the close that volume bubbles a bit, so you'll see it kind of trading in a 5-point range, and it's trading.
Yeah. What's your what do you make of what's happened in the last two opens with these big spikes higher? I mean, the S&P and crude spiked pretty high yesterday. No, was it yesterday? off the Open, and we saw the same thing last night off of the Globex Open. We just see like 100 sort of tick punch ups. That just sort of clearing the book out of stops. Or what do you make of that?
It's really hard to kind of judge what flow is going on. You've got to try and, for us, there's two things. You kind of build an intraday picture and try and spot some orders that are going through. I think overall this market is pretty well supplied. People are quite happy to sell down here. If we're talking about where I think the market's going to go, which I wanted to avoid, but we are here. The thing I've been saying is that I think the Brent WTI spread will reverse and go into backwardation on the WTI side. So I actually think Brent will hit 40 before WTI does.
Interesting. Yes.
The reason is the U.S. economy is doing a little bit better than everywhere else, and the Saudis are trying to smash crude down to hurt the frackers. And what's happened now is they've caused a bit of an explosion of fear into Europe. So whilst crude can obviously, lower oil prices can stimulate demand, certainly stimulate growth, they could also have negative effects for the first 6 months, and we might find that Europe buys even more. So that's the benchmark of Brent. So that's where we might see that flipping a bit.
Interesting. So you think that Brent's going to be trading lower than the WTI benchmark then? That's interesting.
Yeah, I mean, we started selling the spread at about $4.60. It's down to like $1.70 today, and I think it's
closed in.
I think it's going into backwardation. You've got to remember as well. I mean, it's a good understanding for everybody of where refiners are and what they can crack is important. So whilst the US has had the biggest shale boom ever, US refiners can't crack it, because if you run too much light sweet through your pipes, they'll fur up and go pop. Whereas if you run, then they have to blend it, so they're still having to buy huge amounts of Brent, which is really important. So it's important to know that that's happening, because the reason the U.S. hasn't become energy independent, it still imports 7 million barrels, is because no one spent $4 trillion, well, not that, $400 billion completely remodeling and building an entire infrastructure to take in WTI only.
Okay, awesome. Okay, so we'll move on to the next question. I think you did answer that.
We're just getting asked by a customer for a quote. Just hold. Can I just put you on hold for 1 second? Sorry.
Go for it. Yeah, of course. Sorry about this, guys. Obviously, Adam's running his business still, so just have to bear with him while he takes his call quickly. He'll be back in a minute. We'll go from there.
Yeah, only 500. All right, cool. Hi, guys. Sorry about that.
Okay, awesome.
Hello.
Yeah, hello. We can hear you.
All right, cool.
Okay, we'll move on to the next question, okay?
Sure.
Okay, so there is a huge amount of talk in the market. It's not just energy or about the algo systems. Can you give us a view from the two aspects, as means of liquidity and do you see them? So, I imagine by this you mean other algorithmic high-frequency trading systems. Hello, Adam?
Okay. Well, hi. So, if I answer the question of do I think we need them, yes, is the quick answer. Are some of them predatory? Yes, but isn't everyone predatory? In the sense that you want to sell something at 70 and the next price be 60 offered because you feel good about it. So everyone wants to move the market in that way. So the fact that some algos are very, very good at it often causes much greater waves in the market.
Yeah, I've always kind of seen it as even though an algorithmic, say, high frequency trading like our program might be like manipulation, whatever you want to call it, but at the end of the day, they're still having to commit capital to be able to move the market. So it's fair business in that sense, if that makes any sense at all.
Yeah, it does. I mean, so if you have all the orders for futures have got to go into the one order book. In crude, we've got two order books, the WTI on ICE and the WTI on the CME. But if you assume all the orders have got to go in there, we'll leave blocks outside of it for 1 minute. So it doesn't really matter how fast you are, or it matters how aggressive you can be, but then you're committing capital, exactly as you said. In the stocks space, it's slightly different, because if you want to trade Apple stocks, there's 38 exchanges in the world that offer Apple stocks. So I use the analogy that if you go to the supermarket and you walk in and you hear a guy saying, I want to buy 100,000 bananas, and you hear him and the guy goes, I haven't got any, I'm sorry. But next door, the guy just had a delivery of 100,000 bananas. You can jump in your car, race over there, buy those 100,000 bananas, knowing he's coming, and when he comes, you sell them for 1 penny more than you bought them for. And that is basically what high-frequency trading in the stock space does. Now, in the future space, how can you do that? Because everyone's got to go into the central order book.
Yeah, I read a lot about this with the Goldman Sachs 𝗕𝗁𝗔 sort of stock part have about them sort of, how the algorithmics sort of, they front run the contracts in the book. So
yeah, and that's because it's a dispersed market.
Yeah.
So they call it a fragmented market, whatever great word they want to use at the moment. So, the fastest runner, gets the prize. In the futures space, it's largely an irrelevant conversation.
Yeah.
Because our orders have got to go into that book the same as everybody else's. I mean, I can iceberg them, but what's the good in that? It's still there.
So just quickly, what would your take be like on, there's like a whack-a-mole algorithm that comes into the market and it buys and sells the book in a big sort of triangular pattern, sort of buying the highs and lows in like a real short space of time that a human can't even see that. Obviously, you probably know about that sort of algorithm coming in. Do you think that's manipulation?
Everyone's got to commit. So we hunt a lot of stops, but if the market's kind of 20.25 and I know there's stops at 19.95, we'll push it all the way down there, knowing that those stops will be sell order stops and we can collect them all between 90 and 95. But what happens if there's a buy order for 5,000 lots at 05?
Yeah.
So everyone's risking their neck every day. It's just, unfortunately, many times, if the winner becomes a particular party for a larger number of times, it's deemed or felt like it's unfair.
Yeah. Do you think that's basically what happened on the crude close yesterday? We had that big sort of buying imbalance on the day with buyers sort of accumulating inventory, and then into that K period they sort of spiked it down really fast and then brought it all the way back up to fair value. Do you think that was a big stop run to take out stops?
No. That was a company called 𝗕𝗺𝗲, who are a big research agency, who printed an article to say that they think the crude Cushing stocks is going to go to a 54 million barrels, which is a build of 14 million. They published that, so we dumped, if you notice, just beforehand. It was there 20 minutes beforehand.
Yep.
Then they noticed it was an error. It was 1.4 million, so we brought it all back.
Yeah, because I see a lot of
but everyone likes to think it's an algo.
Okay.
To be honest with you, most of our algos, they got caned on the way down and made money on the way up. But the reality of it is that it was just a piece of news.
How do you think a retail trader like me or people on the forum could have traded that or anticipated that without knowing that sort of information beforehand?
Well, it's difficult. Obviously, the energy markets are predominantly traded offline. Vitol will speak to Shell and do a deal, and then they'll speak to, I don't know, Butterfly refineries and sell that. They only enter the futures market when they need to hedge or cover storage. So, but I think the key sometimes is to, I would say, go with the flow, and to understand kind of volume density. It's important to stay close to where the flow is rather than worrying too much about, we actively write algos that hunt people's normal systems like moving averages crossing and stochastics crossing, just to squeeze them a bit more. The reality is, and the key is to try and see where the overall flow is and where the toxicity of that flow is, and basically flow is volume. So there we go. And I think if you take a picture of Brent, WTI and ICE and CME WTI, you've got a good handle as to where poignant hedge flow is.
Do you think it was just by chance then that we see this sort of auction down to VWAP, this big accumulation of potential buyers, this big sort of liquidation down to the previous day's value area low and the low of day on the pit, and then we see that vacuum all the way back up to fair price? Do you think that's just by chance, or do you think that's because of the auction itself?
Well, I think it's a combination of things. I mean, it's important that we didn't break another low in the pit yesterday, which was good. I think the previous day's low in the pit was kind of 72, if I remember correctly, and then yesterday's low was 73, and so there's naturally going to be buyers there, but the selling news came from a news article which pushes general commercial guys to push volume, and that volume becomes what we classify as informed toxicity. And informed toxicity is, a bunch of people, that they know they've received some news, or they physically got crude, or they physically are cracking more. They'll need to buy it or sell it. So that kind of informed volume is rapid volume or accumulated volume, and is going with the flow of that. I think that particular example you just brought up is a good one. It showed the market kind of imbalance drop down to a level where there was a lot of buyers willing to accumulate. The news then being falsified in the sense that it came out in error, and then the market regrading exactly back to where it was, and then you can see afterwards Tokyo just squeezing out the cheap shorts.
Awesome. I'll quickly just run, obviously, my perspective from an auction market theory perspective with what I saw yesterday from obviously an uneducated point of view with news. I mean, like I said, I just see it just being a rotation down to that previous low to test for buyers, and we see all the buyers sort of the buying accumulation building up, and I saw that get cleared out of the market, and obviously the prices ran down on such low volume. We see that inventory correction back to fair value on the day, which was, from an auction market period, is the way I viewed it, without obviously the news sort of insight that you just gave us. So
I think there's a combination though, is that you've got there's a true volume-based theory that you're showing there, and we use an awful lot of volume and time-based algos. They're a benchmark of our business, and so I'm a big believer that volume dominates. And I think what you saw there was just news triggering what needed to happen. I mean, at the end of the day, without buyers and sellers, we all just sit 2021 all day. Yeah. And news triggered a flood, and then the retraction of news pulled it back.
Yes, it's almost a self-fulfilling prophecy then, in a sense.
Yep, I tell myself that every day.
So there's some questions sort of coming in. I'm going to leave the question box here, and you can just answer them as we go if you wish to answer them.
Yeah, sure. So just going to put them up. I can't see them and everything.
Can you not see them on the screen?
Whereabouts on the screen?
You should be able to see them. Can you see the charts that I've been putting up? Or is it just me?
Yeah, I can see the charts.
There's like a box here. Can you see it? I'm moving it.
No, I can't see.
I can just read them. It's not a problem. So
I think what the system kind of, because I'm not because I can talk to you, but you're the presenter. I think only you can see them.
Oh really? Oh, I bought the question box. It doesn't matter. I can just read them. So someone says, let's get it. So the news was leaked beforehand. Ross said.
So say that again.
He said, so was the news leaked beforehand for the reaction to happen?
No, it just came out. I mean, if you subscribe to 𝗕𝗺, which is a big like Platts, it came out, and then it was like an error. They do it all the time. I mean, I don't know if you've noticed, but the Saudi selling prices the last 3 months has come out higher, and then they've said, oh, we've got a problem with our email system, and then 35 minutes later retracted it and sold them lower. Quite a lot of spikes you've seen in crude over the last 3 months. Usually end of the month, middle of the month have been Saudis messing around with their apparently email problems.
Do you think this is on purpose? It sounds pretty on purpose.
The first month everyone said, oh, there's an error. The second month people were going, what the hell's going on? The third month was just like, are you guys kidding us?
It's a kind of big thing to screw up, isn't it? Like, it's a big amount of money behind, so.
Yeah. It actually took the Japanese to email them back and say, actually, they're not the selling prices. Oh yeah, we've done a problem. So these things go on. Welcome to commodities.
Yeah. Okay. So the second question is quickly, because we have to move on. So obviously drifting through time here. But how much importance does volume give and the volume delta? Did I read that right? How much importance does he give to the volume and the volume delta?
Volume delta, none.
So cumulative delta.
I can talk about volume delta because sometimes you'll notice massive volume spikes at a particular point, and often that's us just trying to prove a point sometimes where you'll see like 3,000 lots on the offer and 3,000 lots traded on the bid, and we will just go, using an iceberg, 2021, 3,500 by 3,500, and algos during Tokyo time and into the London morning will just trade with you there all day.
Okay.
So that's printed. We can iceberg it under a one lot or whatever you want to do, and you're printing huge amounts of volume imbalance that a lot of volume traders are looking at. I think an important thing is overall volume done at point and amount of time it's taken to do that volume. So TWAP overlaid with VWAP without being too technical. And then something called VPIN, which is volume toxicity ratios, where you bucket up volume into time. But volume delta, we actually do the polar opposite. So if we see a massive volume delta spike in a short period of time, that's a selling one, we'll buy it.
Yeah, because that's absorption, isn't it? So if you're accumulating 100 contracts there, obviously you're absorbing it. So someone's coming in selling against it, you're absorbing it. And then what do you do with the inventory that you collected? You clear it.
Yeah, it varies. Maybe it may have been short, may have been long. Inventory management's kind of going on the whole time, and that's a moving target. So if you look at developing value areas, how inventory might move, that's why you often find that the VWAP becomes a point. All the passive market makers will be offloading at VWAPs and rebalancing inventory at those levels. So that's why they tend to be, magnets. And then when they get there, they get, pushed.
Yeah.
The thing I was going to say about the deltas is just remember one thing, is that the futures market, you can't have a choice price. And by that I mean it's either 70.71, 71.72, 69.70. It can't be 70 choice. So when you're seeing volume analysis done on deltas, they're all done at choice price. So you're seeing the buyer and the seller at the same point, which is incorrect. You need to see a leg across the two. So what is interesting is often with volume analysis when you leg between it. So try to think of an example as one. I don't know if anyone's looking at a volume now. Hold on 1 second. Another 20 minutes, okay?
Okay.
All right. If you look the last run up on crude is at 58.60 level. Looks like there's a buyer of 228 lots and then a seller at 168 lots. The guy just turned the 200 lot position for a tick. But it looks like those buyers coming in, strong segmented buyers coming into the market. The reality is you've just got to see on those deltas, you've got to leg them up, cross them over. So It's 20. You've got to see what the action's going on at 2021. A lot of the retail guys and the retail software just shows a net delta at price. It's got to be net delta at leg. So that's why net deltas are. A lot of market makers will use it to damage people because they know they're looking at it one-sided.
Yeah, I think there's a big misconception with cumulative to delta. I mean, with how people perceive the information, they don't understand the complexity of that tool. So.
Agreed. And it's very important to realise that price has to occur at what I would say at a different level at all times. There is no such thing as a choice price. So if you understand that, you can start to build real volume. I mean, I'm talking inside the footprint. You know, our systems are sub-millisecond, understanding that if there's a buyer at 20 and then they'll pay the 21 offer, and if he's there selling the 21s, we know he's just playing for a tick, so we'll hit him and push him down and make him give us back at 14, all within 2 seconds.
Yeah, it's very fast. Okay, I'm going to quickly ask one more question and we'll move through because we've got questions, not a lot of time. But so it says, do your algos look at some sort of relationship between TWAP and VWAP?
Yes and no. I mean, you know, there is no holy grail of algo systems. So we have about 46, 47 different algos running at any one time that have all got very specific jobs. But something that we will adjust inventory around volume basis. So that's something we'll do. But you know, if we notice that the toxicity is happening before, you've got to remember, even volume is after the event, marginally after the event, but it takes time to get printed on the TNS. But we will look at, you know, if we're seeing that toxicity, then we'll have another algo that overrides our rebalancer to push, get out. So we're getting given by somebody to say, well, so we're accumulating 300, 400, 500 lots, and the usual model is rebalance that at the VWAP, but we're seeing that the toxicity of that is high. We'll start and push out of it to be short and go with the toxic guy.
Okay, cool. Right, there's another question about automated trading, but we'll talk about that in a minute. 'Cause I have a question. So we'll move on to the next question, and I'll run through the other questions as fast as I can. So the next question is, what are the cost bases to involved in market making to get involved? So how much does it cost?
Yeah, cost of infrastructure. You know, if you work on the basis that we've got about $10 to $15 million in fund at any one time, and we spend about $1 million a year on infrastructure.
Okay, so for infrastructure you mean like software tools and anything?
Yeah, well, servers,
running costs.
you know, market making servers, you know, data center space inside Aurora, data center space in 𝗕𝗁𝗃. We use obviously different ISVs, that's independent software vendors, and different platforms. Overall, you know, the bill is just somewhere shy of about 100K a month.
That's a lot of money. For expenses, that's a lot of money. But I suppose it's all relative, isn't it? So.
Yeah, I mean, one of the questions that somebody said was, do you recommend a good options platform for retail guys? And you know, the CME Direct, their new platform is pretty good. But there's no risk behind it, and anyone can trade an option. You know, you can just ring up your broker and say, I want to trade this option strategy, I want to buy a put spread or whatever, and they'll do it. It's managing the risk, and I think there's to answer the question from a retail side, there's a company called Quick Strike, which did a partnership with the CME that are pretty good. If you're just, you know, taking a punt on doing something, they're worth looking at. But you know, if you are going to be actively trading on a, you know, minute-by-minute base options, or even getting involved more in futures, it's key to get the right platforms because you're handing over money every day, and that's the most important thing.
Awesome. Okay, there's a question I didn't read. I've just really answered quickly. So they asked, do you see stops and the orders sitting in the market on your screen at the exchange? So can you see the order book basically, which I don't think you can.
No, I think there's a lot of, everyone thinks that someone's got this unfair advantage. I see what you see, right? You know, crude's 96, 97, 98. We see that. That's all we see. And I can't see icebergs. What you see in the limit order book is what you see. That's it. We just make an assumption of where we think retail money will be and where we think cheap money will be, and we'll push, and that's what we'll do. I would have known that when we broke 73 on the way back up, that all the day traders would have had their stops there. So, while I've been doing this, the boys have pushed it up through there because they know now they'll buy and they're going to get lifted.
Yep.
So now they're chasing after it. So there's no, we're risking money to make that decision, but it's a logical decision that, the average trader, let's say there's 1,000 of them all putting in a 5 lot, we've got a lot of juice to suck from that, so to speak. But I can't see, I just see what you see, that's it.
Okay, cool. And that's the last question that you've got, and I'll try to run through the form questions. I don't think we're going to get them done, but we'll see. So
I'm okay for time, so no worries.
Okay, awesome. So many people talk about block trades, RFQs, and OTCs. Can you explain all this?
Right, so there's a lot of confusion about this. A block trade is quite simply two parties that want to do a sizable trade above 100 lots, and I could speak to my broker now and say, hey, I want to buy 5,000 lots in crude, and he'll call 4 or 5 other guys that will quote that price, and we can do that trade. And then we have, depending on the size of the order, between 15 and 45 minutes to book that into 𝗕𝗺𝗺, which is the CME's block trade platform. And then that will appear to everybody. So while we've been on this call today, I'm seeing there's some block trades going through, not for a big size, a couple of 100 lots. Actually they're back months, but there's one that's gone through at 47.50. So the guy bought some at 47.50, and he's had 15 minutes to put it through, so he's only 500 lots. And that's all a block trade is. It's just giving the recipient party some time to get out of it. It's not a big secret. The guy's still got to go into the order book and pull that liquidity from it. So if the block trade's happened and someone's bought 500, the guy's got to go into the book and cover 500. Maybe he was already long 500, so it's fine. But that's all a block trade is. It's just giving somebody a bit more time. An RFQ, a request for quote, can only happen on options. A lot of people get confused with this. RFQs are just for options. You can't RFQ a future. So, and the difference between futures and options is futures are always orders. It's a central order book. So you place an order, you can amend it, modify it, cancel it, or what's called suspend it. And a quote, an RFQ, a request for quote, is something that only mass quoting options traders are allowed to do. And it means that a quote is just a faster print. So we can mass quote, if you think about it, 25 strikes across 10 months, puts and calls. So we're doing at any one time, 4,000 to 5,000 quotes a second. If that was orders, the entire CME will just grind to a halt because they just can't cope with that amount of volume. So quotes is a lighter, quicker way of options traders being able to flood the market with their prices. It's nothing special. There's no change to how it operates. OTC means over the counter. So the block trade is also an OTC. So two guys went over the counter, i.e., can I buy 500 lots? He did it. And they then book it through the exchange's clearing systems. The CME's is called 𝗕𝗺𝗺, ICE is just called ICE Clear, and that's it. There's no voodoo magic.
Okay, so can you, when the block trade goes through CME, does that show up on the footprint volume on our charts?
Depends if you turn it on or off. You need to subscribe to it. So quite often, it depends, if you've got a data feed going into a chart software, you might find that you're subscribed to it automatically and you end up getting it, and it's bad volume to have because it can sometimes appear at the wrong times. And if you don't subscribe to it, you kind of don't need to worry too much about it. But it's obviously, we look at it from a visual perspective. I can see the blocks going through. But we don't put it into our volume count because it's always at the wrong time. So it'll say, bought 500 lots and it's 25 to 45 minutes late.
Yeah, that's interesting because I believe with the conversation we had a couple of weeks ago, I got to the point of the IQ feed and the 𝗕𝗺𝗃 CME platform. They actually display the block trades. So from what I can see, because people,
Yes, yeah.
yeah, I remember you saying you had IQ feed as well, but we had some members on the forum that also had IQ feed, and the block trades showed up on the footprint. Where your side it didn't, because obviously you probably turned the block trades off. I don't know, but
Yeah, and I think it's important to turn them off and just use them as manual references. At the end of the day, the guys probably covered the other side, so you're seeing the volume going through. You just don't want to see it, randomly appear. And you can turn it on in some platforms to be able to backfill the next day.
Mm.
So you're not seeing the mess on the current trading day, but you'll see it backfill the day after.
I think that's something I'm going to have to investigate into a bit further because I've not been able to find a setting to tamper with that. But anyway, I can tackle that on the forum another day. Okay, so I think that's all your questions done. So I'm going to run through some of the forum questions now.
Okay.
So Santos has asked some thoughts about the HFT and the business. I know you've answered this, but he's talking about it was initially thought as a good thing because it bring more liquidity into the market, but it's been proven in fact to be the opposite. They remove liquidity in some periods of the day, and only ones trading a certain instrument. And when they decide to switch off their algos, we see flash crashes all over the place. Nanex every day in his Twitter account reports flash crashes in a couple of stocks and futures. What's your opinion on this?
I've got quite a tarnished view of Eric from Nanex, but we'll leave that. We'll pop that one. I think Eric's got to sell his software that shows what people are doing. The bottom line is you don't need to worry about it. If you're a retail trader and you want to do up to 100 lots, you can, on the dime, buy or sell 100 lots in pretty much any product you need to be able to do at any time, and risk manage around that. If your stock's getting taken out, my view is you were too heavily sized for your account, or you pick the wrong level. I think what's happening, if all of the liquidity providers, let's not call them algos, it gets just too crazy, but the liquidity providers in our market are doing a job. At the times of intense volatility, they will widen their price, but do you not expect them to widen their price when there's volatility? If you like, tomorrow morning I can just put crude 21.22 for 5 hours if you like, and we'll order trade on my price of 21.22 until we've done like 5,000 lots either side. But the reality is that people don't want to do that. People want to see movement. So you want to move the price with the volume toxicity. So it's very hard to push crude and futures in the same bucket as stocks. Stocks, when you are informed in the sense of someone just come into BATS and to NYSE and lift to 25,000 lots, and you can get to all the other exchanges before anyone else and lift the price, that's front running. And is that illegal? Yes, in the United States, not illegal in Germany. So how do you front run a globally transparent book that the CME runs? That's why the CME is not involved in any of the litigation that's going on with the SEC.
Yeah, I agree with all that. I've done quite a lot of research on all this, and I think that's a good explanation. I think that's a different kettle of fish, isn't it? It's a different ball game.
Yeah, I've never traded stocks in my life. I just wouldn't. But it's chalk and cheese day and night.
Yeah, awesome. Okay, so Cali Traders asked, I'd like to hear how you approach your day regards preparation, how you got into market making, and a Reef Brill education on I can't understand this. What your role is in the education? Hold on, I don't understand the actual meaning of this.
So I answer the first two. Yeah. We're not as, probably you're all much more well organised with your trade plans and plan of what's going on in a day, way more than we are. We're much more flow driven, and we can change our minds on a dime. And I would say that we're predominantly trading around a fairly large options book, and you can't turn that as quickly as you can turn a futures position. It just, you just can't get out of them. I've got options in December that there isn't a market to be able to get out of them. There are just too many. So you kind of wear it, you get what you're given. And we said, they're a different mentality. You guys always have the luxury of saying, hey, I think crude goes down today, and being short and it going down. You know, if crude goes down, you know, right now I'm still giving you a 76 bid and a 77 bid, and if it does go down, you just traded with us, and you know, so we kind of take your day.
Yes. Doesn't sound like as a favourable side. So I think what he meant by the second part of the question was sort of your education and the role it plays in your job currently, sort of with the education you have. Yeah.
So I got a degree, or 2 degrees, one in computer science and one in maths and economics. My day is literally split between the technology side, speeding up our infrastructure, speeding up our connections, understanding that we are as well placed as we possibly can be to not be clipped all day, and from a kind of mathematical side, making sure we understand our risk. You know, we're basically vol path players. You know, whatever else that goes on, you know, we're looking at what the volatility path is. And there's guys well cleverer than me that work for me that are both building algos that do, you know, a particular function. You know, there may be, you know, we use something called, we're looking at price at time by millisecond, and, you know, we actually look at what's called the micro price. So you guys only see 75, 77 is the current market, 76, 77, but our micro prices might actually say the true value is 76.16, in which case that we would probably lean on a 75, 77 price, and if we get lifted at 77, we'll look for arbitrage there. So the guys are working on that. That's kind of part of our day. But we just kind of invent stuff. 99% of everything we invent goes in the bin. It's got the highest failure rates you could possibly imagine. So if you think we've got guys permanently writing stuff, and I would say we add 2 new things a year, invent 100 new things a year.
That's pretty interesting. All right, okay, so next question is, I can't pronounce the name. I know very little about market making. Could you ask Adam how to start a business from basics, and how's it done? Which markets are mostly affected? Ways, indicators to identify it, and ways to benefit from it, or other ways to protect ourselves from it. So
I don't quite understand the question, but I think people think I don't understand what I think. If you look at the price of crude, if everyone's looking at their ladder now, it's got 74, 73, 7. Most of those prices you see all the way up and down the ladder are us and other market makers. So you're trading with us all day, every day. You don't have a choice.
Okay, cool. I'll get to some cool questions in a minute about that. So
so it is what it is. You know, it's kind of, you can go and be a market maker and just set up an algo on TT and make a 2-way price all the time, and that's pretty much what we do in all of our markets. And hopefully you lose more than we do. And it's you know, whilst we desperately need retail guys in the space, and you need us to make a price, and you make prices. So there might be a retail guy on that offer there at 73, just for a 5 lot. We might want that, and you've helped us.
Yes.
That's just the market. So I think people kind of sometimes think, oh, I sold 5 at 80 and it went to 95 bids straight away. Well, you know, it's a bit like backing a horse. You know, it's just you can't. It's not a win-win situation. I guarantee you, you know, when crude's at $74 and I'm holding the market up, I'm not crying that it's now $48.
Yeah. How you doing? How you doing for time?
I'm good. It's fine. No one's screaming at me.
Right, so let me know.
I'm seeing lots of red flashing lights on one of my screens, and there's someone behind me that's solving it. So all good. Keep going.
So Johnny Tens asked, basically, do you approach the markets differently to the ways that we do?
I think you guys will look for levels. We look for levels. You know, we trade the simple things. I mean, everyone's looking for really complex stuff. I mean, pivot points. Pivot points in crude are highly used by all the old school, all the boys out in Texas, all of the producers. they all look at the pivots. So you'll find the S1 gets sold. There you go. We'll just bounce off S1 up at the figure at 96 now. We bounce off S2 on the way down. These are basics, you know. You couple those with volume analysis and you know, market profile, and that's all you need. You know, I think a lot of people kind of, I see people's charts and it looks like an explosion at NASA, and you know, they've got a Fibonacci for this, and it's confusing. Just, you know, you've got the luxury of being able to say, I want to go to lunch, or I don't want to quote this, or I think it's going to go down, here's my stop. So use that the best possible way and remove as much junk as you can, because I don't mind saying it, I'll hunt that junk. Yeah. You know, if someone's there looking at a kind of, you know, 20 moving average, 5 moving average crossover, we will hunt you.
Yeah.
Because we know where you'll be buying, we know you'll be selling, and it's free liquidity.
Yeah, it's weak inventory.
Yeah, it is weak inventory. It's the right term.
Okay, so Yale FX asked, interested in your approach to risk management on your market exposure.
Good question. So risk management is more important than anything else. You could argue that having a slow serve is bad risk management, so you can kind of get into the space of everything matters to risk management. The important aspect is, you know, from an options book, it's very, very different. You know, we've got to manage our net. You know, the way of managing an options book is just to kind of hedge your deltas. You know, if you buy a 50 delta put for 100 lots, you've got 50 puts of 50 lots of futures risk. So obviously managing that is one thing. We manage it very, very tightly. We're probably oversensitive. We don't really sit there with massive. We will have big positions compared to what people are used to, but we don't sit there trying to fight the market. We will go with the flow. That's the kind of key thing I would say. And risk management comes as a back of going with the flow. And understanding with crude is sometimes you've got to be a bit patient. And we're not a pure futures only market maker, which some guys are. And you know, you're right or wrong with those options, or those futures. You know, if you're long and it goes up, well done. If it goes down, you're nailed. We are always trading around a much larger option book, which gives us that flexibility. I hope that answers the question.
Yeah, that's awesome. Okay, so next one. So if we'll just on what do market makers make their decisions on? What tools and timeframes do they use? And how do they shift their bias in real time, scale in and out of strategies? Just touch base on that if you can.
Yeah, so we don't have strategies. That's the key thing. And we scale in and out around volume, and we scale in around time at volume. And you know, we adjust risk based on what we're seeing and flow. You know, if you look at the book and you're starting to get a load, we'll kind of oversell. It's just, I think, you know, a lot of people kind of call it jobbing around and scalping. If you just imagine that kind of on a much bigger scale, that's what we do. Where we're looking at, you know, there's some huge complexity going on in all of that, but the bottom line is, you know, if I'm seeing a load of sellers in the 90s, and because we're 90 bid, 91 bid, 92 bid, 93 bid, 94 bid, and we're seeing the right type of flow, we're seeing icebergs coming in, we're thinking, okay, there's some damage here, there's the VWAPs also telling us that, you know, there's a sell, we're on a deviation of a time-weighted marker, and we've sucked all the cheap money out as we possibly can, and we're long 300, let's say, at an average of 88, and it's 92 bid. We'll quite happily flip and sell 500 or 600 based on that, and then walk it down. That's the kind of constant change that we're always doing.
Okay, I've just got a question quickly coming. Santos asked if you trade equity futures, ES, NQ, and YM, and what's the difference in your finds regards to crude oil?
We don't trade any. We do. I mean, I kind of, I think the E-mini's going up. I'll, you know, stick my pension on it. No, we don't trade it. I mean, the bottom line is to be a player in that on the E-mini side. You know, you need to have a very, very good pure equities play. You know, you're up against the rig. If you believe that front running is incorrect, if someone's just placed an order to buy 20,000 Apple shares, and that guy's into it first, he will rip the ES book 2 seconds before you see it.
Okay.
And so we can't market make into that space. We don't have, 10 million a year to spend on analyzing every single individual stock on the US stock market to give us a real-time curve. Whereas crude, there's only a few markets for us to be closely analyzing. We started analyzing the dollar a lot more. We analyze soybeans and corn because they do relate sometimes. Ethanol's having more of an impact, so it's easier for us rather than having to trade the S&P 500 and monitor 500 stocks intimately that you're always getting clicked on because someone's spending 10 million a year to get their first rip on an Apple. So they'll take a 500 lot out the E-mini and it's 10 ticks higher, and you're wondering why you're short.
Okay, cool. Like Cookie's asked, you said your personal developments, pitfalls, breakthrough moments, and how long it took, and sort of personal mentors, etc.
Good question. It's taken a good few years. We started in 2003. The market's changed a lot. The people in the market's changed a lot. It's become a lot more digital. I mean, there is no pits for crude oil anymore. It's all done. What you see is what you get in that order book. The only pits left are options only, and it's changed. And I think from a mentor's perspective, I try and I don't have a mentor, but I just try and remain as personally disciplined as you can. I think the key to all of this is understanding your time horizon. If you're a long-term guy and you think crude at 100 was overvalued, then dump it and wait 6 months, and you'll be sitting on a lot of money. If your time horizon is 4 milliseconds, you've got different things to concern yourself with. So the absolute key is your time horizon. And I think if you're looking as a day trader, you want to trade these things, then you need to understand, kind of get two frames of reference: what's going on in that week and what's going on in that moment. And I mean by moment, kind of 5 to 15 minute charts, that kind of stuff. If you're worried about turning 70-72 for 500 lots without anyone really seeing it, then you've got a different time horizon. You're into a sub-tick time horizon, and that's put all your discipline there. What is my time horizon? Can I go to lunch, and can I go and take the wife out to the cinema and not worry about my position? Then your time horizon is probably more weekly or every few days. If that's the key. It's the best advice I can ever give, because people who mix their time horizons, they're the ones that hand the money back to us. I mean, to the market.
So Wingman's asked how to learn trading if started today as an independent trader from scratch.
Okay, good question. I think there's loads and loads of people with systems, and if you go to products like Ninja Trader, etc., everyone's got a system that can save everything. Throw it all away. The easiest thing to understand. I mean, I think what Ryan's doing is actually. I mean, we actually came to talk to each other more, so I've actually taken his layouts because we really like them. We really like how the volume profile and the value unfolds. Focus purely on value, and people say, what does that mean? What's that? I don't understand that. But when a moving average crosses over this, I'll buy it. They think because someone's put some code onto a Ninja screen and it says that this is a swing point, that they feel somehow illusioned to be confident to go and do that trade. It's a very, very hard game. And the other thing I would always say is you should be researching and learning 99% of your day, and 1% of your day you should be turning the servers on or off. There's an old saying in IT that the right data center should only have 2 people in it, one man and a dog, and the dog's there to bite the man if he touches anything.
Yeah.
And trading should be exactly the same. You should be trading only at very, very small. You might be finding that if you're trading all the time, automate it, so you're only turning it on once. It's a job of study, and 99% of your day should be study. You should be a student of the markets. I don't really like that term very much, but more time study, less time trading.
Yeah, I think I've had so many other jobs in the past before I got into this sort this career path, and it just bored the hell out of me. There's just no challenge, and obviously with trading, every day is a challenge. It's a fight for survival. It's I enjoy that nature of the business, and I suppose that's why I've tried to excel in this industry. So.
Yeah, that's it. It's. I think a lot of people are in businesses and they come out and they've got some cash, or they've got after the crash some redundancies, and I'll go and do trading. Bankers unfortunately have not got a very good reputation at the moment because of everything that's happened. But the reality is, it's one of the hardest jobs. Yeah. No one on this call, or me, including me, has any customers. Yet every day you have to go and fight to make money. Now, obviously, if you're a bank, you've got customers and they're paying a nice spread. Block trades go through. You've got an opportunity. You might find that you're on the phone to Tudor Jones and he's block trading 5 different people at the same time, in which case you've just been absolutely obliterated. But the reality is, there's no friends, there's no enemies. It's you versus the market, and it is an incredibly hard job. It's the hardest job, and always remember the 3 nines rule. I always say this. 90% of people lose 90% of their account in 90 days.
Yeah, that's cool. Ahead of time, I've got about another 10 questions. I'll pick them.
Yeah, I've got time, yeah.
Okay, so Roel asked how the large institutional position themselves prior to news, what market makers play on liquidity or in their inventory. That's the first question. I'll get the second one in a minute.
The institutional guys, they tend to be more that they'll take a position, and they may be right, they may be wrong. They tend to be further back in that time horizon. They're looking at movement over a few days to a few weeks. So NFPs come out, they don't really care. Those guys are it's part of that position. The big institutional, if that's what you mean. It's all about your time horizon. Our time horizon for futures is micro. Our time horizon for options has to be longer. You need to understand what your time horizon is. If your time horizon is Goldman Sachs and you just quoted somebody for an option, you go straight in the pit and pass the problem on to me. So the Goldman Sachs time horizon was about 14 seconds, where he's asking for the price, he offloaded it to his customer and dumped the rest on me. So everyone's got a different time horizon, and it depends whether you're broking or you're making a market. When you're making a market, you're onboarding risk. So there's that. What was the other part? What was the second part of that question?
I don't think it's relevant, so I've just left it. I'll move on to the next one. So I'm also interested in learning about how CLOB, RFQ, RFM, and directional orders, and how they can affect steady state assumptions of CLOB. Does that make any sense to you?
I think we covered that with the RFQs and the limit orders. I mean, the bottom line is the central limit order book. That's what that references.
Yeah.
It is the only thing that can exist in the order book is a limit order, and the only thing that creates a transaction is a market order.
Yeah.
And there's no secrets. No one has a magic wand. There's no special types of orders in the CME. All of that exists on the stock side. The bottom line is, if you want to buy 100 crude now, you've got to pay up to 81 while it clears all those offers. If you want to sell 100 crude, you give it down to 72, well 74, and it will do. That's it.
Yep.
You might find when you hit that bid that there's an iceberg at 77. The guy bidding at 77 now for 7 lots might be an iceberg for 1,000. So you sell it at 77, bang, and they're all filled on the spot. An iceberg literally is you can change an order just to show a 1 lot, and you really want to buy 100 lots.
Yeah.
RFMs, request for market, that's a stock term. RFQs are request for quote. We covered that.
Okay. So Andy said, I'd like to be interested in understanding how you use delta specifically. Delta thresholds, higher time frame delta, tracking inventory over multiple time frames adds a lot of context to my trading.
I did see this question before, and I kind of struggled to understand. I mean, delta is just an entity that's created from an option. So if you buy a put,
he's talking about cumulative delta, so the aggressiveness between the bid ask and.
You're talking about. Okay, fine, okay.
I think when we talk about delta, it's always cumulative delta. Obviously, delta is an options thing, so when we talk about delta, it's always cumulative.
Yeah, So what was the question again? Sorry, it was how do I look at over longer time horizons?
Yeah, so do you look at thresholds and higher time frame delta?
No. I'm interested to see the profile of overall volume in a particular day or a week. They're very, very interesting things, and how value is developed. Cumulative delta, there's so many ways of us fudging it. I struggle to see its pure value.
I'll tell you what, I use cumulative delta quite a lot in my trading. It's just one tool that I use to help me understand imbalance and balance over the day and higher time frames, regardless of aggressive and passive order flow. But I think a lot of things that people don't, there's not a lot of education on the forum, because it took a long time for me to learn, is everyone seems to use it wrong, and it's very day type orientated, and it's understanding the underlying order flow of that day around how we use the cumulative delta. So maybe in the future I can go into how I look at the delta anyway. But yeah, so we move.
Yeah, I mean, I don't use it that much. None of the guys have really kind of said to me we need to be doing it that much, and I think one of the things that concerns us is just how much flow goes elsewhere in our markets. I guess if you're trading kind of coffee on ice, no, it really isn't, then all the world exists in that one market, so you're going to see all the flow. If you're trading WTI crude, you're seeing 250,000 in the front month, you're seeing 50,000 in the next month. ICE has got 50,000, and the Brent offset boys, all the arbors, they're all doing a lot. You're only seeing a fraction of the picture.
Yeah.
If you could write a program that aggregates all the known volume at any one time, and then to all the ETFs as well, I mean that volume's not big, but it goes through, get all of that together, you have a really good cumulative delta view. But I think that's quite a big computer to program that.
Yeah, definitely. Okay, I've just run through the main questions I thought were relevant. I've got a couple of questions of my own, and then we'll leave you.
Okay.
So,
has anyone else asked any more? Or?
Yeah, there is actually one more. So, how do the large institution positions do due to their size? Can you detect them and front run them? Will all this algo cause a climax of selling or buying? I think you really sort of touch base on this. But
yeah, you can't front run somebody's order, but you can take it on board, accept the loss, and go with it. I think there's this illusion that a big order comes into the market. I mean, if I see an order in the crude for 300 lots, usually there's a guy who does it for 330 lots. You see him pop up all the time. Just whack it, because he's trying to push it the other way.
Okay.
So you don't see the big institutional orders. You know, Shell don't come along and say, okay, right, we're going to sell 5,000 lots of crude. But overall, you see a damaging time-weighted volume damage all the time. The VWAP's the sell point. And over a period of time, they're just slice hitting you all the time. You've got to take that on, accept the loss you're going to lose, and then flip your position and go with it. We have to do that all day long. I would say, you know, I said to you before, we're trying to take $2 out of every single trade. So it's $10 a tick. We're losing 80% of the time.
That's interesting.
But I will accept someone's volume and think, this is strong volume, we're going to hit everyone, go with this. So the initiating seller at 48.30 today came out of a particular place, and it's strong volume. You get hit, it's 10 offered before you can look, you've long 500 of them, you then go push through all the figure bids, get yourself short, and then it runs off 100 points.
Yeah.
So the first part is take the loss, understand what the toxic volume is, get with it, and then don't expect to ride home to Christmas, get flipped back the other way. And it's understanding your time horizon to understand those things. Because if you the guy who's worried about 3 days, he hasn't even touched the market. I'm worried about 3 seconds. So
yeah, it's different. Do you really just want to touch base real briefly on like how algorithmic execution happens with like 15-30-minute time buckets in the market, and why we see different activity on the different time changes, if that makes sense?
Yeah, I mean, they're the time WAP guys. You see different things at different times. Be very aware of equity markets opening and closing because of the ETF market. Be very aware of the TAS market, that's the trade at settlement. Be very aware of the EFP market, which is exchange for physicals. They're the very, very important things for traders to be aware of. And then you get rotations of time. So you tend to find that you know, one of the things I do is I'm very acutely aware of when every market is open, what time zone every market is in, when numbers are coming out, and more importantly, when equity markets are closing around the world, because crude's susceptible because of the ETFs and the commodity baskets to those kind of changes. And then algos will start and have sell orders. So you tend to notice 4:30 UK time is when obviously we're getting a close in the European equities and the FTSE's going out. FTSE runs on an auction basis. There's a lot of ETFs attached to it. You tend to find that some activity goes through crude because of that. So because these are on hard or half hours or hours, they get very quickly related to particular rotations of bars on charts. The reality is it's the bigger the institution, the bigger the institution, the kind of lower the intelligence of the algo. I'm not worried about what Goldman Sachs are doing. I'm way worried about two guys in a back bedroom in Boston that have just spent 10 years at MIT. But Goldman's just got a lot of business to execute. If they've got to shift all those ETFs, they will just dump an algo into crude and say, I need to sell 3,000 lots in the next 30-minute bar, and the algo will be as simple as that.
Yeah. Okay. So I've got about 4 or 5 questions, and then we'll head off. So how do you use the crack spread? I know you use the Brent crack spread. I look at the US crack spread. I think they.
Yeah, well, I look at all the cracks. It's very important to understand kind of what the refiners are making. So the 321 crack is the key one we use. We actually quote the 321. And the refiners are kind of getting squeezed at the moment, and you start to find that at big figures of that, like $12. We got yesterday. What was the low? The low in crude was $46.80. That was exactly $12 in the crack.
Yep.
And I tell you, there's people screaming at $12 in the crack. So next thing you know, we're up 250 points because they're like, hold on, they'll defend their positions. And they will make sure that it's often that the producers that can help them defend their positions. You've got also kind of the calendar spreads. You want to see rather than sitting there staring at the curve, maybe front against 6 against 12. So in that case, it's Feb, June, deck. Look at those. Understand how those spreads are bending, and that's where people are putting volume. At the end of the day, you've got to get the volume through the front, but you're trying to make a directional trade on the mid curve.
Yeah, maybe you could talk about that option strategy that you were talking about. Is it the wing? At a later date on the forum if you have time.
But. Okay, so you mean on the as an options trader, or because obviously you've got.
Because that's what you were talking about just then, wasn't you? When you were talking about the.
I wasn't talking about options then. So you've got, just to be clear, you've got. From futures, you've got a couple of things you can do. You can trade futures outright, as it's known, do a futures spread, or do a futures strategy. With options, you can trade an option outright, i.e. buy a put and a call, or you can buy an option strategy. 90% of the flow in options is option strategies. Not many people just hit a put or a call. You'll end up just giving money away. On the futures side, you can create condors and butterflies out of spreads. So if you buy a February, sell a March, sell a April, buy a December, you've created a 4-month condor. And that will represent what the front's doing, and then when the middle gets pushed down or the back, you're seeing the wings of the condor move up and down. And all you're doing is trading a future, you're not touching an option, and you've got no outright risk. So if crude moves 400 points left, you're not going to be out by 4. These things move like 2 or 3 ticks a day. But the key is they show how the curve is bending. And 90% of the volume and the trade volume that's going through it is these guys trading these. They'll sit in trading arcades, doing 500-600 lots each, on the bid, on the offer, and that's who you're up against all the time. But they're keeping the curve in line. Someone will come and break that. They'll trade something big in the June, smash the wing on the condor, and then those boys will push it back down. So that kind of level, that's very, very important to understand those curves. The best platform in the world for that is TT.
Yeah, it's a good platform. Okay, cool. So is all your market making, is it all artificial intelligence or algorithmic, or is there any discretion involved in that?
It's not AI. I wish AI existed.
Yeah, well,
AI existed. But we don't. Apart from the brokers, to get the big size done, blocks and options in size are done through the pit still, and the rest of it, it's all automated. I mean,
so there's no discretion involved in what you do. It's all programmed.
No, not at all. From an options perspective, yes. If somebody asks a price, I don't know if you've heard them. I've turned them right down, but the broker's asked like 5 or 6 times, but it doesn't suit us, so we won't quote that stuff.
Okay.
Voice stuff we're not obliged to quote. So yes, that can be kind of discretionary, but we can't. We have to be. It's too quick to trade it manually, so to speak.
Okay. Can you see my screen with the presentation? Yeah.
Yeah.
Can you see the depth of market I've just put up?
Mm-hmm.
Can you see all the spoof prints?
Yeah.
Can you explain why this happened? And
is that today?
Yeah, well, I took that just a minute ago when we hit 47.99. I see that pop up, so I took a screenshot of it because I wanted to ask you this question.
Do you see that quite often?
All the time.
I don't think they're not real prices. That's getting. Let me have a look. The ones in front of all that aren't real.
I know. The thing is I see these spoof prints come into the market all the time, and it seems the market will face the spoof prints. The market will say, "Come to like today. This is what I see." The market came down to the overnight low, and then there was a fake bid. There's a fake seller on the bid. Then obviously this attracts, like, I don't know, retail sellers to come in thinking they're going to front run a big order. Then all of a sudden the spoof print vanishes, and then the price gets sucked all the way back up, obviously running all the inventory out of the market. That's
it's only a spoof print if it's less than 5 seconds. So if the guy's left it there for 5 seconds, the CME won't check him for spoofing. And if they were real, I've never seen that ever in my life, ever.
I don't know if it's my data feed, but I've used obviously multiple feeds.
If you wanted to sell 600 and you went 20 offered, is it 20 or whatever it was? No, if you went 90 offered and you wanted to sell all those, he'll do them.
Because I watched your flow coming in real time, and I see obviously this was an extreme example, but I see 100 print come in, and I watch the footprint, and then the market will come up, and it will go through that 100 print. That order vanishes, and the market obviously goes through it, and no one gets filled on the bid ask where they're offering.
I think there's a data issue on your side, because I'm watching your window on the right, live one, and it gaps sometimes. It creates a gap in the book, and that just doesn't exist. So I've 10 years of doing this, I've never seen crude have an order book like that ever. Oh, and on that image you've taken. Yeah. And also, I was just watching when we just traded up slightly then to kind of 65, 66. There was a gap in your order. It kind of gapped.
This is a simulated dome at the moment, so it might be that it's on simulated and not live. Obviously, I didn't want to press anything, so that might be the case. Yeah. Even on my live dome, I still see this sort of activity with spoof sort of bids coming in.
Can you just record the times when it happens and let me know, because I can check, because I would say that I go to bed seeing the dome flashing between my eyes.
Definitely.
So
I was curious, but yeah, because I see them, like I said, them spoof prints all the time. The spoof print that I see come in, like I said, the market always chases it. So I'll talk to you about that another time anyway. We can run through it, but
very interesting to see why some people are seeing it and some people aren't, because
if anything, it's like a code. Like I see that come up, and I know the market's going to that's the direction's going to, that's what the way the market's going to pick you up.
Like I say, I've never seen so many 100 lots sitting like that.
I don't normally see this, but like I said, it might be because it's on the I put it onto simulation.
Yeah. I mean, obviously, if you see someone offering for 300, I've just said to you earlier, there's a particular guy that does it and then bid for 100. That's just all the fun and games. But as long as he's there for more than half a second, it's classified as slow, so it's not a spoof. By the time you see it physically with your eyes, it can't be a spoof.
Okay.
The spoof stuff's going on inside the spread, and that's where you don't need to worry about it. If you're seeing a bid for 100, you can hit it. It might be cancelled before you can hit it, but if you glance at it and whack it, it's there. I wouldn't worry too much about that. When crude, sometimes what I call gaps. So you'll see like 61, 63, and there's trade going on inside the spread.
Yeah.
That's a very, very, watch for that. It's a very, very particular type of algo. He's very good.
But when I get off this call, and maybe next week, I'm going to record, obviously, my live and simulate and see if they both come up the same. We can run through it.
Yeah, like I said, I've never
I've
seen
my broker otherwise, because I
think, you just need to find out who your feed's coming from. And there's some bad feeds out there. I mean, they will aggregate lots up, and sometimes the aggregator misses, that will add up all the volume on the bid of the whole 10 lots, of the whole 10 mocks, and you end up with those kind of crazy prints. So I can only advise getting a very good provider. If you want to make sure you've got the best, TT's great for the retail guys and pros.
I just pay for I get my depth of market off of the SEO chart, which comes from I think it's barchart.com. I don't know if they provide.
Yeah.
I'm not too sure. It's a good feed. So obviously, like I said, that was a simulation. So I don't know. Okay, 3 more questions, then we'll call it a day. So holding accumulated inventory, sort of what are your time frames in futures?
Varies. Can be 20 minutes, can be 30 minutes, can be, if we get a target, then 10 seconds.
Yeah.
It varies.
Okay. Sort of market maker buy sell programs, the clear inventory, like how is this done? Obviously, like this, when you hunt stops and stuff like that, I mean, you just come in and just literally lift the market?
Yeah, you don't do it so kind of blatant. You've got to kind of work it, and if you want to push this, if your crude's come off a little bit now, and if you want to kind of push it below the stops that will be sitting just under 60 or maybe 55, 60, you've got to get some accumulation. So you've got to start getting everyone thinking it's not rising, it's not rising. So you can't kind of win the battle on your own. So the algos take their time, work the offer, let it run up a little bit. They'll let it go 4 or 5 bid, then come back 5 offered, let people trade on the offer, and push it down to 61. People start losing confidence. It's using machines to utilize human nature.
Yeah, taking advantage of emotions.
You've got to remember is that all you need is one guy to trigger that. So if you knew there's a stop at 59, you need one guy to go, oh, push that. Yeah. And that's it. So here you go. You see every time we're running up to 67, 68, I just see that pattern. I know there's stops under there. But the big volume line on the day is at 60, so they're going to have to work it.
Okay.
So they'll keep working it, push it. It'll drop down to like 48, 50. They'll scoop them all back and then back up to 70 bit.
Cool.
They're just looking for liquidity the whole time. It's all everyone's doing.
Awesome. Okay, I've got one more question. I'll ask if there's any more, and then we'll call it a day. I've asked you this before, but just highlight it to other people. How much of the daily volume is actually held into the next day? So obviously rolled over to the next day, etc. So out of 4,000 contracts that got traded, say yesterday, I don't know how many. I can't remember how many was traded, but say 400,000 got traded. How much of them contracts are going to be committed to the next day's trade?
Well, it's very hard to know that. I mean, there's quite a substantial amount, because I could buy 5,000 Febs and sell 5,000 March. So it looks like hold on a second. I mean, I'm still on this call, but I'm around. Okay. It looks like there's a huge imbalance in the Feb, but the reality is it's just a spread. That's why you've got to understand the whole market. If there's been a load of Brent WTI spread trades going through, that will impact it. We've got loads and loads of outstanding exposure in options but actually the net delta impact is 0. So it's a real, needle in a haystack, that one.
Yeah. Okay. Cool. I've lost my chat box, so I don't know if there's going to be any more questions.
I can only see organisers and panelists.
Is there any questions? If there's questions and I can't see them, can you just raise your hand so I know that there is questions?
Probably millions now.
Yeah, no, I've got them. Yeah, there doesn't seem to be any questions for anybody. So.
Okay.
Okay, awesome. Well, if anyone does have any questions, you can just ask them on the forum, and I'm sure Adam will answer them happily at a later date. To get loads of people saying thanks and learned a lot today, great webinar. So, yeah.
All right. Well, I hope I could be of help.
Awesome. Okay, thanks very much, and I'll talk to you soon, and have a good day. Okay.
And you as well. Thank you very much. Bye, everyone.
Take care. Bye.